All right, so we are live. Let me know if I'm audible, if my voice is clear, and you can all hear me properly. We'll begin in a minute. Let's see if someone arrives. Mhm. Hmm. All right, so yesterday we began with the discussion of accounting. We discussed what's accounting. We did discuss the difference between accounting and bookkeeping. We then went on to discuss the users of financial or the users of financial information who would be interested in knowing the financial information of a business. And then we started with a case where we started building using the accounting equation. We learned about accounting equation, and then using that accounting equation, we started drawing up the statement of financial position of a business. So we will carry on with the example that we had started yesterday. Okay. Also a recap of mm, 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 this one. Yeah, this one. Okay. Okay, so we said that accounting is the process of recording, summarizing, and presenting financial information of a business. We discussed that the sources of accounting, for us, the primary source of accounting would be the international accounting standards, as well, which have now converted into international financial reporting standards. So the old standards, of those which still exist, they are called international accounting standards, and the new ones that are being issued, they are issued under the name of international financial reporting standards. We discussed that owners, potential investors, lenders, which could be banks or other lenders, managers, and the governments, they are interested in knowing the financial information of a business. We discussed that the chronology of accounting process is that first an event happens which has a financial impact. Then we record a double entry of this event to record this event, to record the financial impact of this event. Then we have got the T accounts from double entry. The information goes into T accounts. From T accounts, it goes into balance, trial balance, and from trial balance, it goes to financial statements. Then we discussed that there are five primary financial statements. These are the statements that a business has to prepare if under the IAS it wishes to claim that it has prepared a complete set of financial statements. Those statements include the statement of financial position, or which is otherwise known as balance sheet. We've got statement of profit or loss, otherwise known as income statement. We've got statement of cash flow. We've got statement of changes in equity, and we have got notes to the financial statements. Accounting equation, we discussed it, said that assets of a business, they are equal to capital or equity plus liabilities. All the financial resources that are there to procure or to get the assets of a business, they either come from the owner of the business himself or herself, or they come from borrowed resources, which are called liabilities. Okay, so we had this case of B. Blake, who had started a business, and he had started a business. He or she had started a business with 60,000 deposited in the bank. Okay. Okay. To make the situation clear. Okay. One more thing. One more thing. This is how the accounting equation is usually written, and this is how it is usually used. Some businesses, they reassemble this equation a bit, and they prepare the financial information on the format account assets minus liabilities are equal to capital, or assets minus liabilities are equal to equity. Would mean the same thing. So instead of showing a sum of total assets as we had shown in our example, that first we show assets, we then list out all the assets and show total assets, and then we add up equity and liabilities, and we show that the sum of equity and liabilities, it's equal to the sum of total assets. Some businesses, what they do is they prepare it on the format that assets minus liabilities, that is equal to equity. Again, it's just a difference of presentation. Practically speaking, or mathematically speaking, they show the same thing. Okay, so this B. Blake, he had started the business with 60,000 in bank account, and since being the owner, he had himself put forward that money. Uh, uh, it updated the accounting equation of assets is equal to equity plus liabilities. Now we have got an asset of 60,000 in the form of bank. We have got equity which has been invested by the owner, 60,000, and there are no liabilities. So this is how the financial statement of this statement of financial position of this business would be prepared. That there would be assets of bank 60,000. That's the total assets that the business has, and then there would be equity of 60,000. Liabilities, there would be none. We'd leave it blank for the time being. And then we have got total equity and liabilities which match the total assets. Then what he did was, the second transaction that the business had done was that on 3rd May he had purchased a small shop worth 32,000. So once he bought the shop, okay, if you notice this equation, let's say this is the equation that we're talking about right now. Okay, if you notice this equation, assets are equal to capital plus liabilities. If an asset grows, the asset can only go up if there is an increase in capital. Case number one, asset grows when there is an increase in capital. Situation number two, asset increases when there is an increase in liabilities. Or the third way an asset could grow is when another asset diminishes in value. So that is what happened over here, that when he bought a shop of 32,000, the asset of bank, it decreased from 60,000 to 28,000. That is what has to be done in order to maintain the value of the in order to maintain the equality of the equation. Okay, okay, okay. Um, hmm, hmm. Hmm. So let's continue from this example and let's see for each transaction what update it would what changes would happen to the accounting equation and how that would affect the statement of financial position of this business. Okay, the purchase of an asset by incurring a liability. On 6 May 2007, D. Blake buys some goods 7,000 from D. Smith. All right, and agrees to pay for them sometime within the next 2 weeks. So he has bought something, he has acquired some asset, but he hasn't to get those assets, he hasn't given up any asset of his own, nor has he put in more money to buy those assets. He has instead borrowed from someone. He has told someone that you give me this asset and I will pay you for these assets sometime from now, which means that he has incurred a liability. Okay, the effect. Okay. Okay, 7,000 from D. Smith. Okay, so our accounting equation was this. So assets 28 plus 32. Now he has got a new one plus 7. And over here, let's make it 60. The equity, it stays as it is. Now there is an increase in liabilities. So over here we have got liabilities worth, assets worth 67,000, and the sum of equity and liabilities is also 67 now. 28 plus 32 plus 7, that would equate to 67, and that is what is there on the other side of the equation as well. 60 of equity and 7 of liabilities. Let's see how that would impact the statement of financial position. Okay, B Blake statement of financial position. Now this transaction was done on 6th May 2017. So I'll have it on, I'll update it to 6th May. Assets, they stay as it is, shop, bank. In liabilities, we have got new liability now. Let's say accounts payable. Okay, so account payable is of 7,000. 7,000. Okay, and the sum of equity and liabilities has increased to 67,000. And on the asset side, now he has got a new item which we call stock in trade or inventory. These are the items which a business has, which it intends to sell so that it may carry out its commercial activity, or selling, which is the main purpose of the business. For example, if I am a fruit seller, the fruits that I have, those fruits are my inventory. If I have an electronics shop, all the electronic equipment that I've got for sale, those items are my inventory. We'll look at what else inventory contains in more detail in future, but for now, this is what inventory is. So inventory, he has got worth 7,000. Okay, so now the sum of total assets is equal to total equity and liabilities. Again, what has happened? An asset has increased. If you look at the accounting equation, an asset of 7,000 has increased, and to balance things out, a liability has also increased. The liability is what we have to pay to the person from whom we have bought this asset. Okay. Next transaction. Okay. On 10 May 2007, goods which cost 600 were sold to J. Brown for the same amount, the money to be paid later. The same way we had acquired goods from someone on credit, like we had bought goods from them and we had told them that we'd pay you at a future date, someone else can also buy goods on credit from us, that they buy the goods for now, they get the goods, but they agree to pay at a later date. So these are called credit transactions. And if I bought something from someone and I have to pay him, that is called accounts payable, or that person is called my creditor. Similarly, if I have bought goods from someone and I agree to pay him at a later date, this is called accounts receivable. Now I've got a right to receive money from the one to whom I have sold the goods, and this is the sum of all of these persons. They're called the debtors of the business. Okay, okay, okay. So let's copy this equation. This 28 plus 32 plus 7. Okay, so we have sold goods. What has happened? Goods which had cost us 600. They were sold to J. Brown for the same amount. Okay, so the stock that we have is from 7,000. From this 7,000, I deduct, it would be 0.6 because I'm taking values in thousand. So from stock, a value of 600 would be deducted. From inventory, a value of 600 would be deducted, and a new asset with the value of 600 is generated. Okay. Okay. So So far, what we have looked at is that if there is an increase in asset, increase in asset. How can an increase in asset occur? Case 1, there would be, to balance things out, an increase of the same amount in capital, increase in capital. Okay, case 2 would be for an increase in asset, there would be an increase in liabilities or an increase in liability. Case 3 would be if I have an increase in asset, there would be a decrease in another asset. Okay, so these are the three ways an asset could increase. When an asset increases, there would be an increase in capital, or if an asset increases, there would be an increase in liability, or if an asset increases, there would be decrease in another of the other assets that a business has. Okay, so again we update our statement of financial position. Control C. We break. Now we have to draw the statement of financial position on 10th May. This is now on 10th May 2017. 10th May. Okay. Okay. So we have got a new asset with the name debtors or accounts receivable. What term did we use over here? Used accounts payable. Let's use accounts receivable over here. Accounts receivable worth 600, and that would come from reduction in inventory of 600. Okay, so again things balance out. The sum of total assets is equal to the sum of total liabilities. Okay, okay, shall we look at the concept of current or non-current at this point or not? Maybe we could, maybe we could. Should we? Does it get into that? Okay, we'll look at that later on. Okay, later on. Soon within these assets and the liabilities that we have got, there would be a further classification of current and non-current. There would be a few assets which would be classified as current assets, and there would be other assets which would be classified as non-current assets. But that distinction we'd learn later on. Okay. Okay, moving on. Sale of an asset for an immediate payment. Okay, it's not necessary that whenever we sell an asset, it's for like against credit that we agree that we're selling the asset right now and we'll get the payment later on. There are two types of sale and purchase transactions in this regard. One type is called cash transaction, in which we sell or we buy the asset against immediate payment of cash or immediate receipt of cash. The other type of transactions are called credit transactions, in which payment is deferred. So when we are buying an asset, we say that we buy this asset right now and we'll pay for it later. Or if we are selling an asset, we say that we are selling this asset right now, we are giving you this asset right now, but we'd get money for this at a later date. Okay, so for both sale and purchase transactions, both cash and credit transactions occur. Okay. Okay, so now we have got on 13th May, goods which cost 400 was sold to D. Daly for the same amount, and he paid for them immediately by check. Mm. Mm. Okay, so here we have got further decrease of 0.4 from the inventory, and to balance things out there is an increase of 0.4 in bank, since that person has paid us in cash, sorry, in check, I mean through check, so that would add to the bank balance that we have. Okay, we now prepare the statement of financial position. Control C, control V. Okay, okay, I'm just copying this down to show you that nothing has changed except for the impact of the transaction, that this is the only thing that is changing, all else remains the same. For your practice, I'd recommend you that you draw this statement of financial position, all of it, after every step. So the more you write things down, the more you'll have the practice, and the more the concepts will be clear to you. Okay, so now what has happened is that there is a decrease in a further decrease of 400 in the inventory, and there is an increase of 400 in the bank account of the business, because the person who has bought things from us has paid in check. So again, total assets, they are equal to the sum of equity and liabilities. That accounting equation is maintained. The sum of total assets is equal to total equity and liabilities. This remains the same, and this has to remain the same. If ever at any point of time they're not the same, these two sums are not the same, it means that we have done something wrong. We have violated the principle of double entry, or we have committed a mathematical error somewhere, so we need to check our stuff again. Okay, so far so good. Sale of an asset for immediate payment. Hmm. Okay, the payment of a liability. On 15th May 2007, Blake pays a check 3,000 to D. Smith. So remember, we bought goods from D. Smith some time ago, goods worth 7,000, and the goods we have been selling, but the liability of the person from whom we have bought the goods, that still remains. So now what he has done is he is partially setting that liability. When you're paying to a creditor, depending on the credit terms, it could be the case that you're making them the payment for the entire amount you owe them, and it could be the case that you pay them a partial payment, a partial settlement of their account. So that is what has happened over here. Okay, this was for this one. Okay, okay, okay. So we copy this accounting equation thing that we were showing over here again. Okay, okay. The equation that I'm copying, I'm just copying it to make things clear. When we actually be doing, I mean, when we be doing questions later on, we won't be copying, or we won't be making this equation again and again. This is just a way to show you that things balance out mathematically, as well as in the format in which we have to prepare them. So statement of financial position, that also shows that the accounting equation, it stays intact, and this sum, it also shows you that the things that we are doing, they're mathematically sound. Okay, so what we are doing right now, we are to pay the person from whom we got goods worth 7,000. We are telling him that we are paying you, we are settling part of your liability, so we are paying him 3,000. 3,000 gets deducted from the assets, and 3,000, okay, 7 minus 3, 3,000, no, 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 no. So 3000, that also reduces. 3000 is deducted from the assets since we are paying that person. So the bank balance would be reduced by the amount we are drawing a check of, and the liabilities that be reduced by the amount we are settling the account, by the amount which we are settling the account. Okay. So let's draw the statement of financial position again. Okay, statement of financial position. What is the date at which it occurred? 15th May 2017. So now it would be on 15th May. 15th May 2017. Whew. Okay, so what we are doing is we are paying a check of 3000. 3000 gets deducted from the bank, and the 3000 they also get to go away from the amount that we owe to this person, B. Smith. Okay. Again, sum of assets is equal to sum of equities and liabilities. This shows that we have performed this transaction correctly. Next transaction. Next transaction. Collection of an asset. J. Brown, who owed Blake from 600, makes a payment of 200 by check. So the same way we settled part of our account, we had, for example, the account payable of 7,000, and we chose to pay only 3,000 out of that. This person, B. Blake, he owed us how much? He owed us 600, and now he is making a partial payment of it of 200 by check. Okay. Let's see how would this impact the situation. So what would happen on the asset side? What would happen on the asset side? One asset of bank. The asset of bank would increase by 0.2, because things again, because I'm just using things in thousands denomination. 0.2 represents 200, so the bank increases by 0.2, and the accounts receivable, the other asset, it reduces by 0.2. Since that person is paying us, so our accounts receivable, that decreases. All right. Nothing happens to the equity or the liabilities, they stay the same, no impact on them. Okay, so we draw the statement of financial position again. Control C. Okay, what date is it? Okay, so he makes a payment, J. Brown makes a payment on 31 May. So now on 31st May, accounts receivable reduces by 200, and the bank, it increases by 200. So net effect, thing stays the same. Total assets stay the same since one asset has reduced and the other asset has increased in amount. So total assets remain the same. There wasn't any impact on the equity and liabilities, so their sum also stays the same. Again, sum of total assets is equal to the sum of equity and liabilities. Okay. Okay. Is there more? Okay. Okay, so here it gives a summarized picture of what has happened in the first transaction that this business did. B. Blakey started the business. So what happened was there was an increase in asset of bank and there was an increase in the capital. Would do well if you open the question at this moment and look at this effect on the screen right now so that we can match the two things. Okay, then he bought goods by check. When he buys goods by check, one asset decreases, the asset of bank decreases, and the asset of stock or the asset of inventory increases. Third, he bought goods on credit. Again, the asset of stock or the asset of inventory increased, and and there was a contra increase in the liabilities as well. Okay, sale of goods on credit, it would result in decrease in asset of stock or inventory, and it would result in increase in asset of accounts receivable or debtors. Okay, sale of goods for cash. When we sell goods for cash or check, there is decrease in the asset of inventory, and there is increase in the asset of bank or cash. Okay, if we pay the creditor, what would be the impact? The liability would reduce, and the asset of bank or cash, depending on the mode in which we have made the payment, that would also reduce. Okay, debtor pays money owing by check. A person who owes us money, he pays by check, so the account receivable from that person that reduces, and the check which he has paid results in an increase in the asset of bank. Owner takes money out of the business. Did we do these two transactions, 8 and 9? We haven't done these. Was this shown over here? No, they were not. Okay, so if owner, he takes money away from the business, the same way he puts money into the business, he can also take his money away from the business. That is called drawings, when an owner withdraws money from the business. So what would that result in? Capital would decrease, and as he takes money away, the asset of bank or cash, depending on how he takes the money away, that would also decrease. So capital decreases. On the other side of the equation, assets decrease. Okay, owner pays creditor from private money. Okay, if the owner, it could also be the case in small businesses. For example, I'm running a business. I've got a bank account for the business, but at any moment I may choose that a business has liability since it's my business and I'm the only owner of the business. I may choose to settle that liability without introducing that money into the business first. So what I do is that there is, let's say, a creditor of the business, somebody whom the business owes, that the business has to pay that person some money. Let's say the business has to pay that person a sum of £500. What I can do is that from my personal fund, I pay that person £500. That is equivalent to me introducing that amount of 500 into the business first, and then paying that through the account of business. Accounting, for the purpose of accounting, it has the same effect. Okay, so when I settle a liability of a business from my personal money, that is equivalent to me paying to the business or increasing my capital, and through that capital paying that creditor. So what would happen? My capital would increase and my creditor would decrease. That would be the effect of this transaction. We might have an example of it later on. Okay. So yeah, here it shows the fixed assets and the current assets. Okay, let's talk about that. I've shown it at this point. Okay, the assets of the business, as I told you, they could be classified into current and non-current assets. Okay, what's the difference between a current assets, which assets are current assets and which assets are non-current assets? Okay, the assets which a business intends to convert, with the assets which would automatically, or which the owner of the business, or the managers of the business, they intend to convert them into money within a period of 1 year. So current assets are those assets which are either money right now, or they would get converted into cash within a period of 1 year. I repeat again, current assets are those assets which are either cash or cash equivalent, or they would be converted into cash or cash equivalent within a period of 1 year. Those are current assets. What do I mean by that? For example, if you look at the list of the assets that we have got over here right now, the shop of the business. The business usually, when it buys a premises on which it is to conduct business, it's not for just a period of 1 year, it's for the long term. Usually, when they purchase the office building, they do not say that we are going to purchase it for 1 year. Usually, it is for a period of more than 1 year, for let's say 5 years, 10 years, 15 years, 20 years, or a longer period of time. On the other hand, if you look at the other assets, bank, for example, it's a cash equivalent or almost as good as cash right now. I can withdraw money from the bank, or uh, the bank is for the purpose of facilitating the payment. So it's practically speaking cash. Accounts receivable. Accounts receivable are the debtors of the business. They usually pay back within a period of 30 days at max. If it extends like very far into the future, it may get to a period of 2 months or perhaps 3 months. The debtors, it does not exit their payment period, does never in normal circumstances extend beyond 3 months. Usually all debts, they get settled within 3 months. The normal practice is that it gets paid within a period of months, 7 days from now, 14 days from now, a month from now. At max, if it stretches, it goes on to 1 month, or if it goes further on, it goes on to a period of 3 months, but not beyond that. So within 3 months, that is a period within 1 year, I would have this asset converted into the form of cash. The same is the case for inventory. A business does not hold, or for example, yeah, hold inventory which it intends to sell, let's say, for after a period of 12 months. Why would it hold something right now which it intends to sell after 12 months? That would be a waste of the cash resource of the business. That amount could have been invested elsewhere. So the usual practice is that the inventory of the business, it's, let's say, it varies from business to business, but never more than a month or 2 months. Usually it's for a few days. In some of the businesses, a refinery, they hold an inventory for a upcoming period of around a month. It again, it varies from business to business, and within a business even it varies from material to material, but it is never for a period of 12 months or more than 12 months. The inventory, all the inventory that a business has, it intends to sell it within a period of 1 year. So the inventory, accounts receivable, and bank, these would be the current assets of the business. And the shop would be the non-current assets. That is the shop. The same way we distinguish current and non-current assets, current and non-current among assets, the liabilities of a business, they are also bifurcated into current and non-current. So all the liabilities which are to be paid within a period of 1 year, they are current liabilities, and all those liabilities which would be paid after a period of 1 year, they would be classified as non-current liabilities. So this accounts payable that we have, it would be settled within a period of 1 year, so it would be current liabilities. Okay, if I zoom out a bit, hopefully, you people would still be able to read it. Mm-hmm. Okay, so this is what the statement of financial position of this business looks like in the end. They have put assets, within assets they have put non-current assets, just one non-current asset, shop. Current assets they have put inventory, accounts receivable and bank, and all those assets they add up to amount 64,000. They have got an equity of 60,000, and among liabilities they have got a current liability of 4,000 only. So equities and liability they also add up to become 64,000. So sum of total assets is equal to sum of equity and liabilities. Okay. Fixed asset, current assets, current liabilities. We have talked about that. Okay. This is an exercise which tests your knowledge of using accounting equation. It's a simple one. For example, assets are equal to liabilities plus capital. So if assets are worth 12,500 and liabilities are worth 1,800, capital would be equal to assets minus liabilities. So 12,500 minus 1,800 would be capital. Calculator if here. Okay, so I've got 12,500 minus 1,800 on 10,700. That would be the answer to the first one. The second one says that a business has assets of 28,000 and liabilities of 4,900. So again, assets are equal to liabilities plus capital. Capital would be equal to assets minus liabilities. So 28,000 minus 4,900. 23,100 would be the capital, and so on. Part B, okay. Assets are worth, part C. Assets are worth 16,800, capital is 12,500. How much liabilities are worth? Assets are equal to liabilities plus capital. So assets minus capital would be equal to liabilities, 16,800 minus 12,500. 4,300, that would be the liabilities. So question number 1.1 and 1.2 would be done this way. Let's look at next one. Okay, which of the following items in the list are liabilities and which of them are assets? Do look at this question for a moment. Try to answer it on your own, and in a minute we will discuss the answers to both these, question number 1.3 and 1.4a. Okay, so 1.3, loan to Shirley. We have given loan to someone. It would be an asset for the business. Bank overdraft. Okay, bank overdraft is a situation. For example, I've got a business bank account in which I've got a sum of 50,000. So my bank balance is currently $50,000. I need to make a payment of $55,000. Would my bank allow me to make a payment beyond my current bank balance? In case of business, sometimes or mostly it does, because businesses they get this facility of bank overdraft from the bank. This facility means that yes, the bank would allow you to withdraw an amount that exceeds your current bank balance. So, for example, right now I've got 50,000 worth in my bank account. $50,000 in my bank account. I make a payment of 55,000, so my bank balance it becomes negative 5,000. And if my bank balance is negative 5,000, Next time I deposit a sum of 8,000 in my bank account, the bank first settles that negative 5,000, and then it shows a final sum of 3,000 as my bank balance. So whenever a bank balance is running into negative, that is the bank overdraft. And in those situations, the bank being an S, instead of being an asset of the business, it becomes a instead of being a current asset, it becomes a current liability of the business. Okay, so bank overdraft, it would be a liability. Fixtures and fittings, these are office fixtures and fittings. They are the assets of a business. Computers, assets. We owe a supplier for goods. We have to pay someone for goods. That means we have got a liability. A warehouse we own, since we own it, that's an asset. Classify the following assets and liabilities. Motor vehicles would be assets. Premises would be assets. Creditors for goods. Creditors are the people to whom we have to pay. Since we have to pay them, we owe them. They, for us, they're a liability. Stock of goods, inventory, that is an asset. We have looked at it already. Debtors, accounts receivable, it's an asset. Owing to bank, owing to bank, it's the same as bank overdraft, or it could be a case of a loan. So in any case, we have to pay to the bank, we owe them, it would be a liability. Cash in hand, it's an asset. Loan from D Jones, somebody has given us a loan, that is a liability. Machinery, it's an asset. The same way you can do. Okay. 1.5 and 1.6 are easy. V-Wise is setting up a new business. Before actually selling anything, he bought a van, a market stall. So you have to calculate the amount of his capital. It's easy. You know how to classify between assets and liabilities. You would take all the assets, you would add them, you would have total assets. From those total assets, you would find out all the liabilities from this one. You would add up all the liabilities. So total assets minus total liabilities, that would give you the capital of this business. So this one's easy. 1.7 and 1.8. 1.9 and 1.10, that would be a practice of drawing up the balance sheet. So perhaps we will keep it till here. You can attempt these questions as homework, and Monday, inshallah, the next class that we have, we'll go through the solution to these questions, how they would be done, and 1.9, 1.10, 1.11, 12. Yeah, these are all which we have discussed in one way or another. So it would be good practice for you to attempt these questions, and let's see if you're able to solve these. And inshallah, in the next class, we'll discuss the solution to these questions 1.9 through the last question of this chapter. So that's it for today.